Please take a moment to pause this video and read in full this important disclaimer. This demonstration is for educational purposes only and should not be interpreted as a recommendation to buy or sell a security. Decisions to buy, sell, hold, or trade in securities, commodities, and other investments involves risk of loss and should be taken in conjunction with a qualified financial professional. All right, so the BuyWrite call strategy is basically we're going to purchase the stock at the same time we're going to sell a call. We're going to buy the stock and write the call. The strategy itself is really best designed for those traders who believe that the market is in a bullish or has recognized a steady uptrend in that underlying stock. Now, the strategy can perform even if the stock price holds steady or even falls slightly, but it will underperform if price rises dramatically. And that's because it is limiting the profit potential by the call strike. Maximum profit can only be achieved if the underlying stock is actually called away from us. In other words, the price of the stock is greater than the strike price at the time of expiration. So there's two components here for maximum profit. Stock price above our strike price and at expiration. Now, just because the stock price is above the strike price, it does not guarantee maximum profit. You still need that advent of expiration. Now, we will talk a little bit later briefly about the options to undertake in the scenario of price above strike before expiration. And the strategy offers a limited downside protection by the amount of credit we're going to receive from selling that call. Now, this is commonly called the break-even point or the break-even value. Now, there's a balance here, a give and take, so to speak, of how much downside protection we can create. Now, the greater the protection, there's going to be some variables we're going to need to look at. For instance, the greater protection, I might have to sell a call of greater time value, or I might have to sell a call in a stock that has greater volatility. But if I'm trading a less volatile stock or less time, then that could come to an expense of a lower profit potential. And so what I did was, in preparation for this webinar, I went to the screener a few weeks ago and set up a trade based on what the screener buy screener, and again, AMD was there. So let me walk you through this, and then we'll talk about rolling up. So first of all, when we start thinking about this strategy, again, we want to be slightly bullish, or we want to see a stock that has positive momentum. If we just look at this stock without the details about the trade, we can see that this stock is in, a very positive momentum. A lot of cycles of consolidation, positive consolidation, impulses, positive consolidations, impulses, and again, another impulse. So every time AMD impulses, you can see that impulse, 60%, 30%, right? So I'm anticipating that I'm going to see another impulse. Here is my consolidation, right? And I'm waiting for that opportunity, that breakout opportunity, to put this strategy on. Now, this chart is a weekly chart, but let's walk through the values here. So my initial purchase price for that stock was $112.50, and there you can see it right here. The 125 December call was trading $3.15. So I'm going to sell that call and bring in $3.15 of premium. And that will make my net investment, my break even, my net debit, all the same, at $109.35. The $112.50 minus the $3.15. And that is represented here by this red line. All right, what were those other considerations? Potential profit and static return. So here's my potential profit. I'm going to buy the stock at 112.50 and I'm selling a 125 strike. If price gets above 125 at expiration, I'm going to appreciate by $12.50 plus the $3.15 that I already took in for a premium. That's going to create a $15.65 profit. Take that $15.65 profit divided by our net investments, that 109.35 is going to create a potential return of 14.3%. Notice that I set this trade up just trying to capture a small percentage of one of the last impulses. I'm not going to be a pig. I'm not going to be greedy. I'm going to try to capture maybe a third or maybe a half of some of the performance values that I've seen in the stock over the last month, 6 months, or the last year. Notice I'm only trying to capture 11% price movement. That 11% price movement is going to return me 14.3%, enhancing that return. What is my unchanged scenario? What if the stock doesn't rise in price? Well, I'm going to take in $3.15. My net investment is $9.35, and that would give me a static return of 2.9%. Now, little disclosure here, and I apologize. The formula that I am presenting right here in our screener is actually that flat return. The static return will use the initial price, which would have been $12.50. So what we're actually seeing here is the flat return. But still, we're getting almost 3% for 60 days, right? We're talking about a trade that we put on in October, and our expiration is not into December. So that would work, right? About 1.5% for 60 days, for 30 days. I hope this video was informative. If you enjoyed today's content, make sure you subscribe to BarChart's YouTube channel and give the video a thumbs up. Until next time, the good of all trading.